It is said that when an economy sneezes, banks catch a cold. A struggling economy generally therefore puts banks under pressure. As consumers struggle to pay their debts and are reluctant to borrow more, the business of lending gets more difficult. However, Standard Bank, under tough economic conditions, managed to increase its earnings for the first 6 months to the end of June by 27%, higher than the previous period. Headline earnings rose to 10.5 billion rand, compared with 8.3 billion rand previously. Strong growth was observed in its corporate and investment banking and personal and investment banking divisions, which grew 18% and 16% respectively.
The biggest challenge is clearly the depreciation of the rand and the depreciation of the African currencies where we're operating. So lots of volatility. The deterioration in the price of oil, as well as a whole slew of other commodities, particularly copper, iron ore. And then, of course, the other challenge was making sure that we successfully close our transaction with ICBC, in terms of which we sold them 60% of Standard Bank PLC, Standard Bank London PLC, and then, of course, executing our digitization strategy. So those would be the challenges, I think.
The personal and investment banking division benefited from higher net interest income and non-interest revenue, coupled with slightly lower credit impairment charges.
So loan impairments, our credit loss ratio ended up at about 99 basis points, which is actually very good in the circumstances. But in these tough economic conditions, as I say, it's going to deteriorate, I think, slightly as a consequence of the increase in interest rates and just the tough economic environment.
The corporate and investment banking division saw an earnings boost 54% higher than in the previous period.
It was a combination of things. So they were up 54%. A number of things there. First of all, as I say, we successfully sold PLC. Their cost base is lower as a consequence. We increased the loan book, so net interest income had an expansion. We had a good run in our global markets business. Our trading businesses were up by over 16%, so they did reasonably well. And the portfolio of the entire business did really well, notwithstanding the challenges we faced in West Africa.
The group says they will continue to leverage their brand, market positioning and talented staff to better service their clients, and are confident that business operations in other parts of Africa will improve.
Well, our East African business was down 5% if you take it as a region. It was down because of, it was principally because of our South Sudan business, which had done phenomenally well last year and didn't do so well this year. And then we had a couple of challenges in the Kenyan business, resulting in a 5% decline. However, when one thinks about the opportunities in East Africa, it's exciting. It's an integrated region, some very, very good businesses there. It benefits from the low oil price because it's an East African countries are net oil importers. And then, of course, we've got the Ethiopian business, which we've just started. It'll take us a long time before it gets to scale, because the legal and regulatory environment doesn't permit for foreign banks yet. But when that does happen, we see it as a fantastic opportunity. Ethiopia has got good demographics. It's a big country. And there are some nice opportunities there.
In fact, all of the big four banks in South Africa are chasing growth in sub-Saharan Africa, where economic growth rates are above 5% per year, compared with South Africa's paltry 1.5% last year and potential 2% growth this year.
You know, our expansion plans are very simple. We have got a network that is quite expansive in South, Central, East and West Africa. We don't intend to grow outside it. We're going to grow organically. We're going to, improve our distribution channels, particularly the digitized ones. And we're going to increase product penetration. We're going to increase and introduce new products. We're going to try and increase our valuable customers. And we're going to try and manage risk hard.